From our studios in Atlanta, this is Car Biz Today.
The Kerrigan Advisors Market Update, brought to you by Kerrigan Advisors.
Hello everyone and welcome into the Kerrigan Market Update. We're joined by Ryan Kerrigan, Managing Director of Kerrigan Advisors. Thank you so much for joining us.
Thank you, Bridget. Good to be with you. Lots going on and lots to talk about.
So how did the Kerrigan Index fare for September?
The Kerrigan Index was down nearly 6% for the month, while the S&P was up 0.4%. Each of the component stocks were down, with Sonic down 10% and Group 1 down 15%.
And what caused that?
Generally a pretty poor month for auto sales. Preliminary estimates have auto sales down approximately 7% year over year, and some of the largest OEMs, including GM, Ford, Toyota, and Nissan, have all said they're down double digits for the month.
Did the hurricanes affect the month?
Yes. Interestingly, I think it's fair to say the hurricanes had a significant effect. You had Florence causing significant major disruption in the southeast, with thousands of dealerships closing for a week or more. And don't forget, we had Hurricane Harvey last year, hitting in late August 2017, and September 17 was a very strong month of car sales as consumers throughout the South replaced their cars and trucks in the aftermath of that hurricane. So September is what they call a tough sales comp in the retail business.
Trade wars and tariffs have been in the news quite a lot.
Yes, and that certainly remains the case. The Trump administration has thrown quite a few different variables into the equation. He's been renegotiating NAFTA, threatening the EU, negotiating with South Korea, and putting tariffs on China. Basically, he's thrown everything into the air. We just saw the announcement in recent days that we have an agreement in principle updating the NAFTA agreement with Mexico and Canada. I guess we're now calling it the United States-Mexico-Canada Agreement, the USMCA.
And what's new in this agreement?
Most importantly, it provides some clarity within the North American trading bloc. Based on details released thus far, it seems generally quite favorable to the Detroit Three, who have the most manufacturing assets in North America. That said, it's not quite that easy, as this updated treaty requires congressional approval. Congressional leadership were very quick to point out that approval may not be easy in the current political environment. So I think it's great we have at least a framework for our industry to wrap its arms around, though the caveat is it's not yet passed Congress.
Where does that leave import brands and import franchises?
Well, that remains murky. The Trump administration has indicated they do plan to negotiate very hard with the European Union as well as Japan. Cars will certainly be a very big part of those negotiations. I know that major European manufacturers are building the prospect of tariffs into their 2019 business plans.
And how does that impact the dealers?
Well, that's where this gets interesting. Even if the Trump administration does proceed with significant auto tariffs, it's not clear how this is going to impact the dealers. That will depend upon how each OEM chooses to deal with the issue. In some cases, I think you'll see OEMs not want to reprice their vehicles and lose market share. So you may see some of them absorb these tariffs directly into their cost structure, particularly if they believe this is a relatively short-term phenomenon. So it's possible that OEMs will take the hit on tariffs and the dealer body and the American consumers will not be directly impacted.
And if the OEMs do not absorb these costs?
Well, then you're going to see very significant repricing of the vehicles in question and real changes in market share. This will probably take importers out of the lower priced volume segments, and the cost of purchasing European luxury is going to cost all that much more. It'll be interesting because it's going to really test the pricing elasticity of some of these great European brands.
Which brands are most affected?
It's a mixed bag and really driven more by specific product. Many Hondas, Toyotas, and Nissans are built here in the U.S., so those products are not affected. But across the product lines, here are the brands that would be the most impacted: Volvo, Jaguar, Land Rover, Audi, Porsche, and Mazda, followed by Infiniti, BMW, and Kia. No question dealers are needing to work harder to generate the same level of profits. New car profitability continues to decline. Front-end gross in the new car department is down 49% in recent years. Some dealership groups continue to pump out consistent and even record levels of profits, but they're doing that by showing great execution, particularly in the area of cost management and really focusing on other parts of the business model. Dealers with strong fixed ops, used car operations, and collision centers are really benefiting from their diversified business models.
You mentioned the used car business?
Yes, the used car business has been quite strong. To that point, CarMax just recently announced earnings, and revenues up 9% and earnings up 22% for the quarter. Stores that are on cruise control or really reliant on the new car business can easily see profits down 50% since 2015. Others, focusing on the other parts of the business model that I mentioned, continue to post really strong profits. I'd also note that changes in OEM incentives have had a real impact here. Ford, Nissan, Chevrolet, and Mercedes come to mind. Dealers with those brands have faced very significant changes in factory money in the last year or two, and in some cases that has really impacted dealership profits.
It is a partnership model between the dealer and manufacturer, isn't it?
Yes, it certainly is. Dealers are in a very important, complicated relationship with their OEMs and are significantly impacted when the OEM makes changes to the product line or to its incentive systems. On this note, a Ford dealer recently made a very compelling point to me. He said Ford made the strategic decision to exit the passenger car business because of pressure on the board and management by activist investors, basically Wall Street. In response, Ford made a very abrupt announcement. Ford will exit the new car business. The dealer told me, I have no issue with Ford trying to proactively make decisions about its product line, but had Ford talked to dealers about the messaging, the dealers would probably have guided them to a much less dramatic public announcement. Something about shifting product lines and recognizing the importance of SUVs and CUVs. The abrupt announcement, catering to the financial markets, unnecessarily severed the relationship between Ford and the many people who recently bought its cars. How would you feel if you were a Ford Fusion buyer, you just picked up your car a month ago, you've got 59 payments left about the Ford brand when they just announced they're no longer in the car business? I thought this was a great point, and it gets to that critical relationship between OEMs and the dealers.
Does that speak to the close relationship the dealers have with the consumer?
That's exactly right. The point of the franchise system is to put great local marketers in each and every market and bringing that market knowledge back to the OEM. In this case, it's a good example of that system not being used to its full potential by the OEM.
So how was Ford's announcement received by Wall Street?
Well, it did not move the stock. Since the announcement of exiting the new car business, Ford stock is down 30%. To be fair, GM and FCA are down over that period as well, but the point is the announcement did not move the stock. But it did disrupt the relationship between the dealers and the consumers.
Thank you so much, Ryan. Always great talking with you, and we'll see you again next month.
Bridget, my pleasure.
CBT Automotive Network, the #1 most watched network in retail automotive.